I don't invest in crypto, but I think there's some potentials over there. So for someone who is like, hey, you know what? We got a great run, made 1,000x increase on this, which is possible in crypto. And I want to diversify some into real estate, but I can't find a project yet, or I want diversify between passive investment as well active stuff. How do I do that?
Great question. So step one is you form a trust and you get with our team and you it's all conditional, by the way. You sign a conditional engagement agreement, and that allows us to form a trust, get it set up prior to the exit of the cryptocurrency or the business or the real estate. In fact, we just closed a cryptocurrency deal for a client. They were selling some Ethereum. They bought it for 100,000 and some Bitcoin mixed, and it went to about 13.5 million.
Yeah.
And they're living in the Bay Area. He's working in a big tech company. She's an attorney, and they're like, you know what? We want to exit. Now, by the way, this journey was a wild journey. It wasn't just 100,000 to 13 million overnight. It was like a 6-year journey of just, blood, sweat, and tears, if you will, on looking at the crash and the ups and the crash and the up.
Yeah.
And the reason they didn't sell is because of the tax. And so they call us up and they're like, hey, Brett, if you and your team can solve this, like we're working with the financial advisor as well that I work with at a San Francisco. She's amazing. And we're all working. We're like, if you can solve this, we can solve this. Like we're ready to exit. We're ready to diversify. We want to go buy potentially a cabin on Lake Tahoe. We want to retire from our day job. We want stability versus the highs and lows of Ethereum and Bitcoin. So I said, yeah, what's the steps? Well, step one is we actually form a trust. Step two, we open up a trust account at Kraken. We use Kraken as our main one. Step three, they actually transfer the Bitcoin and the Ethereum to the trust account. And then the trust actually sells it to cash. And the note holder, which in this scenario, they become the lender. This is what's happening. His name is Peter. He lent the money to the trust. In this scenario, we exited 5 million within an hour. Ethereum hit about 3,000. That was his exit price to exit. And so that's kind of the basic mechanics. The smoke clears, the trust bought and sold for the same price, 5 million. They received it for 5, they sold it for 5. So that has no tax. And the note holder, they receive a promissory note. They lent 100% of the 5 million to the trust. Transfer the Ethereum and the Bitcoin for a $5 million promissory note. And this is why this works. This is an installment sale. And as long as we follow those guidelines, they're in a deferral state. And at which point the funds can be invested, stocks, bonds, mutual funds, or again, real estate back into crypto. And they get back to them. The goal is that original 5 million plus an additional 8% rate of return. And that's really kind of it. That's kind of how it works. And then they just pay tax on what they receive. When they receive it, they can pass it to their kids and keep it going. But it's not uncommon. I mean, people do installment sales all the time. Like you might own an apartment complex for 10 million, no basis, no debt. You could carry paper for the buyer, right? You could say, hey, look, you give me 3 million down. I'll finance you 7. I'll pay tax on the 3. But you'll slowly pay me that 7 back over time, and then I'll pay tax on that. You could also do 100% financing, right, if you wanted to, but you would never do that in a regular deal because they have no skin in the game. But in this scenario, you don't mind doing it because the collateral and the trust can be secured against some of the biggest companies in the world. It could be in Netflix, Google, Apple, Costco. It can go back into your own multifamily deals or passively into other deals with partners. It can go back into crypto. So hopefully that's making some sense.
Yeah, definitely. Yeah, I'm kind of like start coming around it. It's still obviously very big in my head. And so in this case, when I'm using this trust to buy, then decided to buy multifamily because let's say, or passively invest into multifamily, how then would you execute that? Does your share still kind of held in the trust, or does your ownership held in the trust, or is there another way to kind of come out of it, or is there a need to come out of it?
Yeah, let me tell you another client deal story. His name is Shay Pope, and he did a podcast, and we did a joint breakout conference at the Best Ever Conference with Joe Fairless, with Dan Hanford and a couple others, and a whole panel. Okay, so he sold a business for $2.6 million in Alabama, and he had zero basis. He deferred hundreds of thousands of dollars of tax, and his goal was to go build multifamily projects. In fact, he was building a 72 multifamily unit in Tennessee, and so step one is get the funds into the trust. Step two is to identify that business venture, which was the real estate. Step three was to form an LLC. Then the trust can invest with you actively or passively
Mm-hmm.
into in this scenario was active, so some of the funds went into the LLC, and then LLC was used to help build the project and invest in the bigger LLC. And so
Gotcha.
there's some details in between, but that's really it. It's just a silent partner with you. Like we call it the go fund yourself, right? You can go get
Mm-hmm.
money from a lender or another investor, but I could partner with the trust that owes me the money that I would have paid to the
Right.
government anyways
Right.
and build the project. Like that's really cool, right? So that's
Yeah.
how that would work. And the same thing could be done for, again, for crypto, whatever you're exiting, a business, a primary home. We did a $8.3 million primary residence in Palo Alto. I know
Mm-hmm.
places like Bellevue and other high-end areas near Seattle are going to have owners that have lived there for a long time, but
Mm-hmm.
they feel trapped because they have a
Right.
huge tax. They cannot
Mm-hmm.
do a 1031, whereas the deferred sales trust can do that. By the
Uh,
way, the deferred sales trust can also save a failed 1031 exchange. This
okay.
is really important for those that are listening, that you have a backup plan. It
Mm-hmm.
doesn't have to take one of the identification pieces, and it can save it as long as you're working with us and the accommodators that actually want you to know about this. There's a lot of
Mm-hmm.
accommodators who don't want you to know about this. There's
Right.
brokers who don't want you to know about this because they want to keep you in the 1031 commission thing. But
Right.
which is totally cool if you can find a deal that makes sense and they earn their commission. I'm still a
Right.
broker. I still do 1031 exchanges.
Yeah.
It's not always the most sense of that. So those are some of the reasons why you'd use a deferred sales trust.
That's awesome. So let's say someone is always doing the 1031 exchanges. And for one or the other reason due to markets and whatnot. And then let's say one of our growth plan is to 10x our investors' wealth. By doing so, 1031 exchange is one of our strategy to do so. But in between, we get investor asking us all the time, like, hey, what happens at the end of when you 10x this self? What's your plan? Obviously our plan was like, well, we're gonna go build a class A buildings and put it on the 5% yield, and then we cash out refi. That being said, could the trust be a possible alternatives for projects like that?
Yeah,
And
great question. So first, we want to define the problem. The problem is somewhere between 25 to 50% in capital gains tax and
correct.
depreciation recapture on the exit of these assets. Okay,
Yeah.
and so at a certain point, a lot of syndicators that we work with, either not all of the entity wants to move. In other words, like a third of the investors want to get cashed out, and
Yes.
the other 2/3 want to move, and that create a problem.
Mhm.
In fact, we just did it for a commercial real estate syndicator. I think it's over $50 million now worth of real estate in 4 different projects,
Mhm.
multifamily, where they took their GP positions and they exited, and one of their LPs also did it as well into their own individual trust. So the deferred sales trust is like Netflix, in
Mhm.
that the whole partnership entity doesn't have to move. In a
Mhm.
1031 exchange, the whole entity has to move.
Yes.
Okay, and so we can separate, and people can either pay their tax or do a trust. Okay, so that's now our minimum is 1 million net proceeds, $1 million gain. By the way, very important
Mhm.
to see who qualifies. We don't
Mhm.
do smaller deals unless you have 2 at 500 each that you can combine in a short period of time.
Mhm.
Reason is because of the cost, and it has
Yeah.
to be a home run for you,
Yeah.
and a good deal for us. And so that's kind of where we have those minimums. But yeah, but to answer your question, yeah, we again 1031s are great if you can make them work, and all of the partners want to go. But at a certain point, yeah, you do want to separate, and then it's just a
Yes.
mathematical equation. How
Party
much am I
always
paying?
come to the end, right? So
Yeah, how
yes.
much in tax am I going to pay, right? And then what does that look like? Also, with ours, you get a brand new depreciation schedule, okay? Because if you own
Mhm.
multifamily for 27 and a half years, you fully depreciate. Or if you do some
Yeah.
cost seg, you decelerate that. And when you do a 1031, the depreciation schedule travels, whereas the deferred
Mhm.
sales trust, you can get a new one. If you're active in the partnership with the trust, there's some caveats, and you only get 80% of that the way we set up the structure. So it's not a perfect silver bullet for everything. But
Mhm.
that's why we at Capital Gains Tax Solutions will compare the 1031 exchange, opportunity zones, charitable remainder trust, and then the deferred sales trust. Also, the deferred sales trust tends to be the most of the silver bullet for what our
Mhm.
clients are looking to accomplish. Because
Mhm.
right now, the largest wealth transfer in the history of the planet's happening. It's our parents, Elisa. They're the baby boomers,
Right.
and they have over $32 trillion of assets that they're looking to pass to us, the
Mhm.
millennials, but and or the next generation. But they're just looking at like huge tax if they
Mhm.
exit these properties: primary
Right.
homes, businesses, investment real estate. Those 3 asset classes represent 50% of the total net worth of America. And every
Mhm.
day about 10,000 baby boomers are turning 65, and there's 77 million in the US alone. So
Mhm.
you combine all of this perfect storm of all of these assets that they want to trade, but they have this huge tax. And so they're not
Mhm.
looking necessarily to get into new toilets, new trash, new liability, especially in a marketplace that's absolutely insane when it comes to cap rates being in the threes and the fours and lack of value add deals and interest rates going higher and people wanting to have diversification and not have a lot of debt, right? Right now,
Mhm.
debt is not your friend
Mhm.
if you're overpaying for a property. Debt can be your friend if the property makes sense, but just be
Right.
very careful with that. And this is where we provide so many solutions for people, as well as estate tax. Okay. The
Mhm.
deferred sales trust can eliminate 40% of the death tax for ultra high net worth clients,
Mhm.
which is an added benefit that the 1031 can never do.
Yeah, that's awesome. Now, tell me a little bit more about, thanks for touching on estate tax. Tell me a little bit more about how this vehicle can be used for kind of estate tax, because the interesting question over here is like there's always an end to the deals. You decided not to do this, right? Or you decided to take a break, a long break, or you decide to take a short break, or you decided I'm out, like there's enough for the legacy and my kids don't want to take that over. So in these scenarios, how does this kind of plays into strategy with estate taxes?
Yeah, in fact, it's the most important question. How does the deferred sales trust basically eliminate estate tax on ultra high net worth clients'
Like eliminate,
portfolio?
not defer, right?
Yeah, literally eliminate. Yeah, it takes it
Yeah.
outside the taxable estate. So the deferred sales trust takes funds outside the taxable estate, but basically changing the characteristic of what it is. So you can either get a stepped up basis, which is ownership, or depending on how we structure it with what we call our DST 2.0, you can change your characteristic. You won't get the stepped up basis, but you will move all of your funds in equity outside the taxable estate. So first, define the problem. What's the problem? Well, if you're worth $22 million or more married, and any of that's inside your taxable estate, you're going to be hit with a 40% death tax, or
Mhm.
12 million single, although that's set to cut in half in 2025 to about 12 million married, 6 million single, potentially even lower.
Mhm.
So the idea is to get it outside the taxable estate. The challenge is most people can't gift enough, can't buy enough life insurance, and it's really expensive life insurance, or give it all away to charity. With the
Mhm.
deferred sales trust, in one day, in one transaction, we can move all the funds outside the taxable estate, which eliminates the 40% death tax, okay? Because it's
Mhm.
outside the taxable estate. As far as the how-to, you got to sign NDAs. We go through all of that in detail,
Mhm.
but it's been audited. It's been tested. One of the biggest deals is the $125 million deal in San Diego that it was done for. We just did one for a $5 million client, a $25 million client out of Colorado who sold a multifamily property. And so, yeah, you just get connected with us,
Nice.
capitalgainstaxsolution.com to learn more.
Awesome.